why a focus on quality growth companies works in emerging markets. I guess the first point to start with is does it work in emerging markets? And that's something hopefully we can answer with this is the performance of our emerging market fund since 2012 against the MSCI Emerging Markets Index in red. 257% performance, about 140% outperformance over the period that we're talking about. So I think you can say that perhaps our approach does work. There are times when it doesn't work as well, and there's a few. The nimble-eyed amongst you will probably see that there's one or two areas in that chart that didn't work so well. 2016, 2022, and really 2025. We lagged the monster rally that we've started in emerging markets. But I'll come back and touch on why that may be the case, and why that's the exception rather than the rule. So how do we define quality? And it's a very nebulous concept, and obviously as a fund manager, if I stand up here and say I'm going to buy really bad companies, you're probably going to think, well, what am I doing? Have I gone completely mad? So clearly, most fund managers, most active fund managers are trying to buy what they think are good, high quality growth businesses. And this is where we define it a little more clearly, I think, than many others. With our 315s, sounds simplistic. It is quite simplistic, actually. But let me just explain a little bit about what we mean by that, and why 15 for that matter. Is that a good number? The first one is return on equity. So as shareholders, what sort of return are we getting on our investment? And one of the problems that people have is you want to make a return for a business, but what's your cost of capital? That varies a lot. Your cost of debt, cost of equity, and so forth. We find that particularly in emerging markets, that's a pretty difficult thing to pin down, and quite often it's a theoretical number. It moves around quite a lot, but we feel that that it's far better to look at a company and say, well, okay, if it's returning 15%, there's a pretty good chance it's going to be beating its cost of capital. Whether that is 8%, 10%, whatever, possibly even 15%. But that's why we use a consistent number across all our companies. Now, that's also worth pointing out that that's not an easy number to achieve. We think our universe for our emerging market fund is a little shy of 3,000 companies, 2,700, something like that. When you do a simple screen, which is not what we do necessarily, but if you do a simple ROE screen for 15%, that number drops to about 300. So about 1 in 10 companies it achieves that goal. The second thing we look at is cash return on assets, or in more detail, cash flow return on operating assets. And why do we look at that? And that's really the fact is that if you've got a business that wants to grow, and we do want businesses to grow, if you're going to grow, you're going to have to finance that. You can either finance that through more borrowing, through debt, leveraging up the balance sheet, or you can do it through internal cash flow. And we prefer the latter. We tend to find that companies that use too much leverage will come back to the market and dilute you as a shareholder. And so that's what we look for in the cash flow. Does the business make a decent return on its investments? Now, 15%, again, why 15%? If you think of it in its simplest terms, you're building a factory to make widgets. Your chances are you're going to finance that factory for 5 years. At the end of that 5 years, you want to be able to build another one, and that would require that sort of number of cash flow to make that work. And then the final one is earnings per share growth, and clearly we are looking for growth companies. We're investing in a high growing part of the world, the emerging market world, and again, but 15% is to us a reasonable goal. You're doubling your profits over 5 years again, and that's a reasonable number. So that's really the background to our somewhat simplistic 315s. How we do the rest of the fund, I'm not going to go into too much detail today, but needless to say, we are index agnostic. We seek opportunities across the emerging market world, and we have a very high active share. We're very focused, typically 35 companies in the portfolio. And over time, 80% of that alpha I showed you earlier has been generated from stock selection. The easiest way to put that into some sort of context is to look at some examples. And I'm going to start with Varun Beverages. Not a household name, but it's by far and away India's dominant Pepsi bottler, and by definition, one of the dominant soft drink bottlers in India. They have been incredibly successful over the last decade or so as a listed company. It's a business we got to know when it came to the market in 2016, and have been following it pretty closely ever since. A few familiar products in their range, but also one or two others like Sting, which is the third from the left there, which has been a very successful competitor to Red Bull and other energy drink makers in India. And I say, other than that, the usual Pepsi suspects. But this is a chart of return on equity of Varun Beverages over its listed lifetime, which is a little over 10 years. You can see it pretty consistently above our 15% after the initial couple of years. A dip in 2020, which was, needless to say, COVID related, and then a very strong few years in 2022 and 23. And what happened there really was in 2019, Varun used to do most of their bottling in northern India, and they took over the businesses of Pepsi in the southern 7 states of India in 2019, and they'd been pretty poorly managed, and Varun came in and turned them around, and this led to the pretty spectacular returns that followed in 2022 and 2023. This brings me to the next point, that there is too much of a good thing when it comes to ROE, and I think that's one area that we have to be careful about, and why we focus on what we think is a manageable number at 15. And you can see that when a company like Varun Beverages, very well managed business it is producing return on equities of 30-35%, that's probably unusual. At the end of the day, they're buying concentrate from Pepsi. They're building a bottling or canning plant and shipping it out through the market. It's not rocket science, and I think the trouble with that is when you are earning these very high returns, you start to get competition come in, and Reliance, huge Indian conglomerate, which I'm sure most of you will have heard of. They bought a local brand called Campa Cola, and have come in the last few years with a view to winning market share by undercutting the main players. And it's not destroyed the business, but it's made it much harder work. And we're starting to get back to a return on equity that is much more sort of normal, if you like, for a company like Varun. From our point of view, as I say, listed in 2016, which is at the start of this chart, we bought, having got to know the company well, from between 2019 and 21, and really started selling from 2022 onwards, partly because the position size had become a very decent sized part of our portfolio. And we sold out over the remaining couple of years and until early 2025 when we sold out completely. Again, it's a stock that we will keep on the watch list and keep an eye on, but not one for us at the moment. Another example, sticking to India, no particular reason, is Eicher Motors. Now, Eicher Motors is an Indian, mostly motorcycle company with a key brand of the Royal Enfield brand. And if any of you have ever been to India, you will have undoubtedly seen some of these on the streets. You can see from this marketing picture, it's the ultimate aspirational brand. This does not look like a doorstep or an average doorstep in India, as you can imagine. But it's clearly aimed at pushing that brand, and it's in many ways it's unique. It's a pretty irresistible brand. Every time I go to India, I usually visit a Royal Enfield showroom. I was in one in September, and you kind of just want to buy the product. Basically, it's extremely attractive, extremely well made, it's extremely well marketed, and it's as I say, it's a pretty unique brand. The thing about it, is also if you've been to India, you will have just heard the sound, which is it's a little like a Harley, but it's slightly different. But again, a pretty unique brand. They have 80% share plus of the 250cc and above motorcycle business in India. Again, something of a pattern here. A very strong return on equity over the period of time, over the past decade or so. The possible excess return in that 2016 to 2018 period. But again, the dip is more to do with the cycle in India, and India introduced some very aggressive environmental norms or requirements in 2018-19. This resulted in the cost of a motorcycle in India, and this wasn't just Royal Enfield. This was every motorcycle going up significantly, and sales fell as a result. And since then we've come out of that very, very strongly. But again, you could argue that it was over earning in that 2016-18 period. And as it's happened over that period, you've seen Harley Davidsons and Triumphs and others come into the market. Now, we don't think they're really competitors because their pricing is 2-3 times what a typical Royal Enfield will cost you in India. But still, I'm sure looking at these returns, that was something that incentivized them to start coming into the market. Share price of Eicher Motors, we bought back in 2014. In fact, the fund had very little in India prior to 2014, and this was one of the first shares that we bought when Narendra Modi was elected in 2014, and we became very optimistic about India, and it was a stock that we'd monitored and one that we bought into. We sold it in 2017. If you remember, that was a period when the market went into decline. Again, the company did not really do anything wrong, but it was just in the wrong place. And then we bought back in 2022, and it's been a very good share ever since. I'm going to take a slight aside before going back to another example, and really just to look at what I call the perils of dilution. These charts were taken from an FT article quite recently, actually, and the one on the left just shows Chinese GDP in the dark blue line over the past, this decade, this century. The the light blue there is total listed earnings, so total profits, which have pretty much kept pace with the GDP growth. But the real problem for us as shareholders is the red line is the earnings per share line, which is probably half, by the looks of eyeballing it, the growth that we've seen in in the GDP and the total earnings. And so, what's that all about? What does that mean? Well, the chart on the right just shows the market cap of the development of China. The blue line is the dark blue is the stocks that were listed back in 2000. The light blue line is stocks that have added through IPOs, and the middle blue line is other sort of typical rights issues, capital raisings in the market. And the red part is the bit that's almost uniquely China, but it does demonstrate the problems of dilution quite well. Is that these are other dilution aspects. Now, this is a market that's dominated by state-owned enterprises. These are companies that have the minority shareholders have been diluted by just new shares being listed by the government. They're very capex heavy. It's been financed by these these injections or share dilution. This is specifically China, but it's a problem in more generally in certain countries and in certain sectors. And it goes back to why we focus on the internally generated cash flow, the cash flow return on operating assets. Because if you don't have that, then the chances are you're going to get diluted. I mean, we very seldom buy state-owned enterprises in any country, let alone China, because for the obvious reason that they're not really working for you as a shareholder, they're working for the government. But it just highlights some of the challenges that you want to avoid. Now, that doesn't mean to say that all of China is like that. And there's also some extremely good entrepreneur-led businesses in China, which we've invested over the years in the past. Companies like Tencent have been a stalwart of the portfolio, a bit less today. But this is another example, CATL. Again, I think most of you will be pretty familiar with CATL. If you're not driving a car with one of their batteries in, you may well be soon. Dominant global player in the automotive and electrification battery. Probably one of the standout winners from what's been going on in the last couple of months in Iran. All it's doing is accelerating that move towards electrification, whether it's in the power grid, in homes, or in the vehicles that we drive. And CATL has a 40% global market share, and is multiple times bigger than the next player, which is BYD, which obviously uses a lot of their batteries in their own cars. But this is how the cash flow and returns look for CATL. Red line is return on equity, pretty steady, particularly after the first few years where it was a little below the 15%, but ever since 2021, comfortably above, but also not excessively above, and that's quite an important point to note. Cash flow return on assets, extremely strong, and this is a chart that, as a competitor to CATL, you should be getting worried, basically, because that cash flow profile is not repeated in any others in the sector. Arguably, BYD is the closest. That's obviously not a pure play, but that's a very powerful combination. Extremely strong cash flow, allowing them to invest in capacity, but keeping returns at a high but realistic level. and ultimately, dominating the cash flow in the sector. This is a stock that we've only owned for a year or so, but I think is going to be a very exciting stock and a really world dominating business. The next example, the last example I'll talk about is probably, as I said, the prime example, which is TSMC. Again, you will be familiar with TSMC, and it's not a surprising stock to any of you, and it will be in many portfolios and emerging market portfolios in particular. But I mean, the one thing is this is the actual assets in red and operating assets, and the actual cash flow in blue. So clearly, this is a growth business. It's been particularly in the last sort of 20 years, it's been a very steady growth business, and a very consistent cash flow return on operating assets. Much higher than our 15% requirement, but in a very sort of strong picture. Return on equity also again consistently above the 15%. Certainly, post the turn of the century tech bubble and burst in 2000, but also not excessive that often. Clearly, there is a cycle in this business. It's by far and away, the leading semiconductor chip maker in the world, and there is a cycle. But there is much less of a cycle in TSMC than there is in almost any other tech companies you'll come across. They were in Edinburgh a couple of weeks ago on their sort of annual roadshow. Interesting to listen to them, and they are almost at pains to explain about that this is a cycle, and that their view is we look after our customers. We are not going to gouge them. We're not going to over-earn when times are good. Yes, they are a little high on their ROE at the moment, but it's exceptional times in the sector. But the fact is, what they've done in using that cash flow I showed you in the previous slide is just dominate the sector. And their view is, and they don't state this, but their view clearly is to keep the competition at bay, but keep them alive. It's bizarre when you talk about Samsung Electronics, one of their top competitors in this foundry business. And I've been listening to Samsung Electronics for 25, 30 years, getting into the foundry business. They still don't make any money out of foundry. And that's after 20 plus years of trying. And they're very good at making semiconductors. So it's a very solid place to be. And it's not surprising it's the largest stock in emerging markets. And this is what the share price has done in this century to date. This is a log chart just to put it in perspective, but it's it's been a very strong share. Those of you familiar with our fund is that we did not buy technology stocks until 2 years ago. Because we had a focus more on consumer stocks, and there was some concern about the cycle. But at the end of the day, as I've just demonstrated, TSMC is a prime example of a quality growth company in emerging markets. So why would you not? I did mention at the start that there are times when when this consistent growth process does not work, and there are setbacks. This just shows that the sort of steady compounders, which is a group of stocks that largely mirrors the kind of stocks that we look at. As you can imagine, these are companies that can compound growth with without excess need of capital or anything like that. And actually, you can see it's outperformed the emerging market world by 8% over 8% per year. That is per year over the period. You can look back early again in the sort of 99, 2000, 2001 period. There was a period of underperformance, and that do happen. Occasionally it does happen. In the last year, the steady compounders have underperformed by 5%. So they've given a chunk back. But again, we view these as temporary situations and ones that we're probably coming out of now. Just to look at where that all adds up with our portfolio, and the return on equity of the portfolio 21%, well ahead on average of our 15%. Very strong cash flow, 29%, and also well above the market and well above our requirements for growth, and a PEG of 0.8, which is about as low as it ever gets. And that's one thing we haven't discussed much, which is valuations and something you have to take into consideration. One thing I would add here, though, is that net debt to equity is a negative number. So the median company in our portfolio is net cash. In fact, most companies clearly in the portfolio are net cash. So that return on equity is not being generated by leverage, but it's being generated by high quality businesses. And that's really where I'll leave it. I think, going back to the performance over time, we've returned 9% annually versus under 5% for the index. It's a very strong process, which we think is the right way to invest in emerging markets. And with an eye on the clock, I will stop there. Thank you.
Thanks so much, Rob. That was really interesting and really great examples too. Just from me first, you finished with the performance slide. Obviously, you've got great long-term performance. Do you think you could just maybe comment on sort of the last few years, particularly maybe 2025, what you felt that may be down to and how that might change this year and beyond?
Yeah, I mean, I think that's it's clearly it's a good question. I think there's part of that is as I mentioned, there was a real change of shift in the markets, partly towards technology, which we captured well. Actually, we've had some good exposure to the Korean semiconductors and TSMC and some of the other Taiwanese companies. The flip side really was kind of India and China, which have been two big markets for us over the life of the fund. And India had a particularly difficult year in 2025. And with hindsight, maybe that does come down a little bit to valuations. And I think we always pay close attention to valuations, but those valuations are based on our earnings expectations, and those were a little optimistic in India, clearly with hindsight, and that's we were a little slow to recognise that and come out of India, and China itself has been a difficult market over the last few years for all sorts of reasons, domestic economics and so on. What I think is particularly encouraging for us is and actually I've just updated those numbers for the last quarter, and actually the numbers I don't think in our portfolio have ever looked more attractive. Actually the peg now, median peg is now 0.7. Extremely strong growth, extremely strong cash flow. I think there's been a real derating in India, and to a lesser extent, and lesser extent in China. It's been a sort of longer, slower burn in China, which makes those markets very little downside and potentially quite a lot of upside. So I think that's why we're excited about performance turning around. Obviously, the last couple of months, or the last month or so, has been volatile, but actually quite positive.
Great, thanks, Rob. Someone's asked, in the Farron Beverage example, you say you got to know the company. What does that look like in practice?
Yeah, interesting one. I mean, it's really just about meeting the company, talking to them regularly. We've whether it's on the road or in their office in Gurgaon and outside Delhi, and as I say, it's one of those. We very seldom buy IPOs because at an IPO you don't really know the company. Yes, you've got a sort of 100-page prospectus, which is written by lawyers, and that's all well and good. But until you've seen how a company behaves, I think in the listed equity market with outside shareholders, it's pretty difficult to get a strong view. And I think we've so that's why we didn't buy the company till 2019. I think it'd been listed 3 years. We got to know them pretty well. I mean, the company was founded by Ravi Jaipuria, the father figure, and actually, I mean, his son is called Varun, which is why the company's called Varun. Slightly weirdly, he has a sister company called Devyani, which is named after his daughter Devyani, which does a different business. So it's not related, but it's a fast food business. So yeah, that's it. It's just getting comfortable with the way they run the business and their management and over time, and it does take time. Yeah.
Nice one, thanks, Rob. And I think we'll finish. So someone has asked, and it'd be interesting to get your opinion on this, but does the target market client for EM typically need to have a longer investment time horizon than your average global fund or domestic investor?
I think it's perceived as a volatile asset class, and therefore higher risk, and therefore you should take a longer term view. And there are ups and downs. To be frank, it's an unusual combination of countries these days in emerging markets. You have two really quite developed markets in Korea and Taiwan, which would not look out of place in Europe or I mean, they are clearly developed and rich nations. And then you have two powerhouses of up and comers, China and India. And then you have a long tail of others of a mixed bag. But the real most funds are 80% would be in those four markets, which are probably less risky than they used to be, I would argue, and a few sort of niche interesting places like Brazil as well. But so I think one thing I would say is until this year, to last year, emerging markets has been a unloved and ignored investment place, and I think that may well be about to change. I mean, last year was a good year for emerging markets. It's continued this year, and I think you do get these periods of underperformance, and we've had a very long period of underperformance, and whether that's because the US has been dominant or whatever, but I think there's a very strong case to be made that we have a period of outperformance in emerging markets from now.